Welcome to Web3 Watchdogs, the podcast that takes a deep dive into the world of Web3 security, compliance, and risk. Join Michael Pearl as he interviews executives from across the Web3 industry to uncover the challenges and opportunities of this rapidly evolving space. Web3 Watchdogs is sponsored by Cyvers, your one-stop shop for Web3 security and threat mitigation. Cyvers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cyvers.ai. That's CYVERS.ai.
Hello, everyone, and welcome to the Web3 Watchdogs, the podcast that focuses on everything security, compliance, fraud prevention, risk management, basically everything that has to do with safety and security in the Web3 space. And today we have Sebastian Heine. Sebastian is the Chief Compliance Officer and the MLRO for the United Arab Emirates, and he's going to explain what an MLRO means in a second. For Mantra. Sebastian, welcome.
Yeah, thank you, Michael. Happy to be on the show.
Thank you so much. So without further ado, maybe you can introduce yourself, tell us a little bit about the background. How did you end up working for Mantra? And basically, what does MLRO mean?
Yeah, of course. So my name is Sebastian. I've been in the crypto space for some time, always working in compliance or financial crime role, which also brings me to the explanation of what an MLRO is, because it's a money laundering reporting officer. Usually every regulated firm needs to have one. You can sometimes outsource the role, but the officer is responsible to report any incidents or suspicious activity that the firm has identified in regards to money laundering or other financial crime. So that could also be sanction related, which of course is quite a bit topic. And a bit about myself. So I started in the traditional finance space. So I was a consultant and then turned banker. Then worked in consulting a little bit again for KPMG. And then while I was at KPMG, I had a lot to do with fintechs. And I really liked the way of working with the fintechs because it was a bit more dynamic. You were working with cutting edge usually. And that really interested me. So I went to move on to eToro, where I helped them build up their compliance function in Germany. And it was one of the first companies which applied for the crypto custody law in Germany at the time, which was way before MiCA. So every country had their own laws, or most of the countries didn't have a law at the time. And yeah, after that, I stayed in the crypto space, worked for Ember Group, and then Norstec, and now I'm working for Mantra Finance, which is a regulated entity of Mantra, which is a bit of a novum in that sense, because we are layer one blockchain. Our headquarter is in Hong Kong, and we're focusing on tokenization, but we also have a regulated entity, which is the one here in Dubai, which is regulated by VARA, the local digital asset regulator. And we have 3 licenses with them.
Very interesting. And may I ask, so you mentioned eToro and Ember, so you have quite a interesting point of view about the Web3 compliance space. What drew you to the space, and what do you enjoy the most about compliance in Web3?
To crypto, I started, as many people started, kind of talking about it with friends and colleagues. That was back in 2017, while I was still in Credit Suisse. So people were talking about trading, the ICO time. So everybody was comparing which coins to bought, etc. So that kind of drew me into the space. But then it took a couple more years until I was working in the space, which of course sometimes people also ask me, how do you get into that space? How can you start a career in compliance in crypto? Because often people don't really find the entry point or don't really know exactly how to best enter the space. But for me, it started, as I mentioned, through the fintechs, and what drew me drew me in was that kind of radical new theory, right? That they're going to replace the financial system, financial freedom of being really in charge of your own money. And I think that can speak to a lot of people.
Yeah, for sure, for sure. So you mentioned mantra briefly. I would love to dive in deeper and to better understand. I'm gonna say up front, usually the question that arises when you're talking about a blockchain in general, but an L1 in specific, people say, "Oh, another L1. What's the purpose of having so many blockchains?" So maybe you can specify what is exactly the differentiation of mantra versus other blockchains? What's the vision behind it?
Hmm. Yeah, happily to say that, because you're absolutely right. It is a common question, and people often say, "Okay, I think we have enough L1s, right?" But let's see if we're gonna get more or not. But what really differentiates Mantra is that it was a blockchain which was created with tokenization in mind, and they were the first ones to do that. And so they implemented compliance into the blockchain modules. It's a Cosmos SDK based blockchain, but now we also added EVM compatibility. So we are quite versatile in what assets we can tokenize on the chain and with which other partners we can connect. And then additionally, of course, we have the regulated entity, which is a added value for us, because we think that the tokenization of the future will happen a lot with regulated entities, and regulated entities often can't really interact with DeFi protocols, etc. So they might be able to use the infrastructure, but then they would need to build all the rest themselves or use other service providers. And we kind of want to provide the infrastructure and then some modules on top. So it's basically a modular approach to what you can use, and then they can plug and play what they want to tokenize.
Got it. And how does it work with Mantra? Do you have smart contracts? Do you have projects that are building on top of you? Because always, EVM chains, it's easy. It's all kind of copy paste with some modifications. But
Right.
when you go to the realms of Cosmos SDK, it's always a little bit of a mystery.
Yeah, so Cosmos functions differently, right? What Cosmos brings to the table is these modules where you have banking modules, you have compliance modules, and with that, you don't really need to build all the other things that you would need to build on EVM blockchains through smart contracts. So it's less friction and also less risk that you have to manage. But we, of course, also have other teams that build on top of our chain. For example, for recently we launched the DEX, right? And they built on top of our Mantra chain. And now we have a bridge and so on. And you have all these ecosystem ecosystem D apps that you need to provide all the services. And we also, of course, don't want to build all the things ourselves. It's first of all inefficient, but also you know, like doesn't really speak to the ethos, because basically we want to be agnostic, but want to provide some core services that we think are absolutely needed.
Got it. And I have tons of questions for you right now, but just to refer to something that you mentioned earlier. So you said banking modules. What does it
Mhm.
actually mean to have a banking module on top of a layer one blockchain?
Yeah, it's basically allowing you to manage accounts or financial products more efficiently. So that's what they call banking module. I mean, obviously, it's not a banking system in a traditional sense, but it helps you then to direct finance and payment flows more efficiently within these models, and also synchronize prices, etc., with other chains, because it's kind of the fundamental difference of Cosmos. They build the Cosmos ecosystem to be able to function very well in a multi chain world, which of course I think is very important.
I see. So I guess at this point, some of the listeners probably think to themselves, why do we need a chief compliance officer for a blockchain? Because
Mhm.
usually when you think of a blockchain, right, especially a blockchain kind of in the beginning of its way, then obviously you need developers. Maybe later on you need chief information security officer, Then you need ecosystem managers, but compliance. And I know it's a funny question, but it's kind of goes counterintuitively to the decentralized model and the decentralized ethos, also to the global ethos of blockchain, right? Because compliance is very local. So maybe you can help settle this dilemma that I have here.
When crypto started, I think not a lot of people were thinking about compliance, rather the opposite, right? So I think that's kind of the point that you're making. But as nowadays everybody talks about, the institutional players moving in, BlackRock moving in, banks moving in, etc. Compliance is on the forefront of so many crypto companies. And for us as a DeFi company, because we kind of see ourselves as a DeFi company, so we of course want to open up our products to as many people as possible. But for the licenses to work with Vara, we absolutely need a compliance officer, because basically what you then are doing, or what a compliance officer in that environment does, is not so different from let's say a security expert, because basically you're ensuring the ecosystem is protected, the firm is protected through good policies, good procedures, and these then help you show a certain standard of quality, which then helps you first of all get a license with a regulator, but then also be more easily interacting with banks, asset managers, and so on, because they know you already have a certain standard, which you usually wouldn't necessarily accept from other crypto companies, because their tech might be really good, but they don't really look out for things like anti-money laundering or sanctions. And then sometimes for financial institutions, they just cannot interact with these type of companies, because then there might be a sanction risk, for example. And then they say, okay, it's unfortunately not possible that we can interact with you.
Yeah. So you mentioned a license. What type of a license does a blockchain have? Because essentially, we all know VASPs and CASPs, obviously for crypto exchanges and custodian licensing that you've mentioned earlier. But for a blockchain, what type of a license do you have?
No, it's not the blockchain itself that's licensed, because you can only do some security audits and so on, right, for blockchains from a technology perspective. But the entity itself has licenses for, or the regulated part of Mantra has licenses for exchange services for our decentralized exchange. And then we have broker dealer, so we can offer financial products through our regulated platform. Of course, we can also offer products outside of that, but that then would be different products usually. And then the last one is called investment and management. So that originally by Vara is more of a portfolio management license, which we're going to use to offer vaults and these kind of products. So it's more of you commit capital into a pool, and then you get a certain yield back, and that in a regulated way, basically. And that's why we got these 3 licenses. And currently we're going for one more license to kind of complete our offering, but unfortunately can't say too much yet, because it's still in progress.
Got it. So you're not going to provide any scoops right now.
No, not yet. I think I'll wait a little bit. I can only say that we're in the final stages of it, and it's a very, logical addition to our other licenses. But yeah, happy to reveal that hopefully before the end of the year.
Got it. And probably the reason for so many licenses is the fact that you want to offer financial vehicles, basically like tokenizations, and to tokenize real world assets and things of that sort, right?
Yeah, correct. And I mean, Vara also splits these things up in a lot of different activities. So you also kind of need a couple of licenses if you want to offer different types of products, right? In other jurisdictions, maybe you only need one license, but here in the UAE, you really have to select which products you want to offer, and then go for multiple license usually.
Got it. And from a standpoint of a blockchain, let's talk a little bit about the liability that managing a blockchain has, right?
Mhm.
So I think like 2 weeks ago there was the balancer attack. If I'm not
Yeah.
mistaken,
Mhm.
$128 million stolen. Fun
Yes.
fact: Cyverse was the one that detected the hack and announced everyone basically about it. But one thing I remember from that incident is that Berachain basically halted all transactions on the blockchain until
Right.
they could figure out. And obviously, it is unfortunately it's quite common in cases of hacks. Can you specify? I mean, we all read about it in the news, right? And
Mm.
oftentimes, users of, let's say, Berachain, for instance, they can be very angry about it because essentially it always shows them that the network is not really decentralized as they would like
Yes.
it to be, and so on. But
Right.
from the compliance standpoint, from the regulatory standpoint, what
Mhm.
kind of obligations does a blockchain have with respect to such incidents?
I mean, it's a very good question because I mean it's very current and on the top of the mind of a lot of people. Some people really don't like to think about that their blockchain that they invested in or that they have tokens of or money on the blockchain, that this can be just stopped, right? I mean, if we go back a couple of years, it wasn't that uncommon that Solana, for example, would just turn off, right? Because I think to this day it has turned off a couple of times because it is much more centralized in that way than other blockchains. Of course, that is was more about the technology and the beginning, and they have made a lot of progress since then. So I don't really expect that to happen anytime soon. So there's one technology part. To shutting blockchains down, and then the part that you mentioned, which is the regulatory aspect, which is basically protecting the blockchain of risk if somebody launders money through your blockchain, or in that case, of balancer takes money out of the blockchain to steal it. And I suppose the expected party was North Korea in this case, right? Um, but yeah, I mean, from a regulatory point of view, you definitely have some obligations because you wouldn't get the license with Vara if you couldn't demonstrate that you can. They always talking about freezing transactions, but that you could kind of freeze or intercept transactions that are in the process of money laundering. And the way that we could do that would be through a validator quorum, right? So we would need the majority of the validators to agree to it, and I think that's probably the most for most blockchains. So it's really a measure of last resort, and usually we would try to use other measures first. For example, if a specific smart contract or module then is attacked, then we would of course try to leverage that to stop the funds being drained. But the last resort measure could be that that the blockchain is being halted, and that is also a requirement by Vara. So some regulators do require these things, and I think that's a little bit of a disconnect, right, between the decentralized ethos and the reality of being regulated and attracting institutions, because also decentralized protocols like Uniswap and so on, they can't really nowadays anymore being used for laundering North Korean funds. Because if you remember, there was this Tor chain protocol, right? And they got a lot
Mhm.
of negativity because they were after, I think it was after the Bybit hack, if I'm not mistaken, right? And then Tor chain was used to get all these funds out and launder them. And that got a lot of negativity or negative publicity, which can be a massive problem because if the publicity or like that goes really high, so that financial crime investigations are started, lawyers will start their work, the regulators will start their work, and then all of a sudden you're being sued maybe for being complicit in a hack that you didn't really have anything to do with, right? So every company tries to protect themselves against these kind of risks. But of course, I think there's I think there are two things to learn from that. For one, I think kind of the crypto community needs to understand this, that these risks exist, and of course it would be an idea that that we don't even need these functionalities. But the reality looks a bit different. So I think there's a bit of education in the crypto community necessary, that these are things that exist today. And I think there was also the a Bybit report recently, right, where they said like 16 blockchains can be halted or frozen or something like that. And a lot of people reacted shocked about it, even though probably the people working a little bit with it from a security or compliance aspect, they probably knew it already, right? So,
Yeah,
but
for
yeah,
sure, for sure. And
interesting.
it's definitely interesting because usually if you read the media,
Hmm.
being someone that sees kind of under the hood and seeing all the processes that are happening kind of in the back office of it, right? So you
Hmm.
always read in the media only about the theft itself, right? The
Yeah.
action of stealing the funds. But
Hmm.
what people don't really realize is that there's an entire process that part of it is very fast, right? It happens in milliseconds that the funds
Hmm.
are being dispersed to different wallets and so on, laundered, mixed, going cross chain and so on.
Exactly.
But some parts of it are, taking longer to actually cash out on the funds. And it's
Yeah,
kind of a race against time to figure out where the funds went to, and
definitely.
for platforms, right, to figure out that you're not absorbing these funds. So
Hmm.
that's kind of to provide the full picture. But I'm curious, how do you actually do anti-money laundering as a blockchain, right? Because just to give some perspective here,
Hmm.
if you are a centralized, for the sake of the listeners, right? So if you are a centralized exchange, it's quite easy because you have deposit wallets and withdrawal wallets, and then you have to
Hmm.
monitor what goes in. Oftentimes, you don't even have to monitor what goes out, right? Because for the most of it, your biggest headache is what goes in, and then it's much easier to do. But when you have an ecosystem of
Hmm.
thousands of wallets and hundreds of different projects that all of them are moving funds, how do you even mitigate that with respect to AML and keep it the ecosystem clean from money laundering?
Yeah, I mean, it's of course, as you say, very, very different task to monitoring a centralized exchange. But mostly how we do it is because what you need to understand is our first priority is to protect the regulated ecosystem, right? So where users have KYC to access certain products, because that entity, that's the regulated one, is the one that has a primary obligation to report money laundering, right? Because the other entities who kind of manage the broader chain while still managing risk, they're not necessarily obligated to track, to monitor all transactions. So it's a bit different in that sense. But of course, we work with Elliptic, for example. So we use Elliptic to monitor the smart contracts, and because we're a DeFi company, it is a bit different because we can't monitor the funds being sent to us, but we can monitor, of course, the funds being sent to the respective smart contracts, and then also analyzing patterns more or less in the same way as a centralized exchange would do. And then, for example, if we then see that something illicit is going on, then we can interact with a smart contract and, for example, ban that specific wallet for from receiving any more funds or moving any funds that it didn't have access to. But of course, because it's decentralized, the funds that are in the wallet itself are also for us not reachable. Because yeah, the funds are in the custody of the user.
I see. So let's talk about tokenization and real world assets and all the other buzzwords that essentially are talking about creating liquidity for illiquid assets, right? So the
Mhm.
idea for those who are not familiar with these terms is essentially that you can take anything, anything of value, starting from real estate, a beautiful building, or commodities, or any other basically valuable asset, and essentially create a tokenized version of it, and also a fractured version, right? Because you can take a building, and instead of buying, a small percentage of the building, you can buy a token that represents this percentage. So until now, it sounds great, right? We've all, you remember the ICO era. I remember
Yeah,
it
of
as
course.
well. We read a lot of white papers, where the problem always starts, where the rubber hits the road, so to speak, is
Hmm.
when you start talking about, the actual possession of that fractured asset, right?
Correct.
Because
Yeah.
if I now engage in some sort of a legal arrangement where I
Hmm.
buy a part of a building, I have some sort of a deed, or like semi deed, right, where
Hmm.
I hold
Right.
as property, putting my lawyer hat on, I hold some part of the building. But whereas when I hold a token, the connection between the token and the actual asset is not very clear. So perhaps you can clarify that. How does that work, and how do you mitigate that?
I mean, tokenization pretty much so far has worked in one way only, which was that people would create a fund on the Cayman Islands, right, as a vehicle to hold then shares in another company, which would then represent the legal title. Let's say you want to invest in real estate. Let's take that example. Then the other company or the Cayman Island entity would hold the real estate, and then the user would buy shares in the Cayman entity, and in that sense would have a share of the real estate as well. So that's pretty much a very common model. But of course, ideally, you would want to have it a different way, right? Which is a way that we're seeing now in the UAE, where, for example, it is possible to hold the deed directly through your wallet, because a wallet token translates to the deed directly, because the Dubai Land Department opened up their registry and is the first one in the world to do so. So you can actually buy and sell your token, and in that way you can actually buy or sell the deed, which of course quite revolutionary. And I
Amazing.
mean, for other assets, usually the Cayman solution with an SPV makes sense. So it's a special purpose vehicle, and these are just special types of funds which are very well designed to hold assets of any type. So it does make sense to use that vehicle for other things, for example. But we are seeing more and more the move, or the transformation to a fully digital journey, because we also now seeing stocks, for example, being offered tokenized, right? So, and some of the providers on the market still do it through an SPV vehicle, but some of the other providers already offer stocks directly in a tokenized way through, I believe, Nasdaq, for example, right? So I think more and more we are moving into a world where these asset holding registries really are connected to the blockchain, and I think that's very exciting. But it is still a bit of a longer way for some of these assets, and for some assets it also wouldn't make sense to do it that way necessarily, because if you let's say, for example, hold a private credit, and people can buy shares of that private credit, but the private credit would then be offered through a private company, and then the best way to kind of interact with that would probably be a Cayman structure, or any kind of fund structure in that sense, because a private company is not listed in any registry anyway, so there's no way to trade it other way. And for these type of assets, where tokenization then also can open up liquidity to the holders of the assets, because you have a possibility to, as you say, fractionalize the asset, and then sell or buy it in a secondary market. I think that's very interesting.
Yeah, it's super interesting what you just told me about the UAE actually providing a government sponsored legal status to tokenized assets. That is really quite revolutionary. I still remember something like 3 years ago, there were discussions in several jurisdictions in the US
Hmm.
of doing a similar thing with NFTs, and it
Hmm.
didn't work back then,
Right.
due to a bevy of reasons. And also, it's interesting to see that actually the fungible tokens and not the non-fungible tokens are the ones that eventually were selected to serve as a tokenized asset. But
Yeah,
it's really interesting. Yeah,
that is true, right? I think all the first iterations were always based on NFTs because it kind of made logical sense at the time. But then I think there are also some technical limitations, throughout the life cycle of the tokenization. And in the end, then you have to burn the NFT if you lose it, right? And then how's the NFT going to be transferred and these kind of things. Um, so it is interesting that nowadays we are seeing more fungible tokens being used for these shares, because then the shares usually represent an equal amount of that asset. So they are not non-fungible, but they're actually fungible because all these shares are the same.
very interesting. And we're approaching the end of the conversation, so I would like to kind of wrap it up and kind of summarize everything that we talked about, and present kind of an open philosophical question to you, right?
Okay.
Because we talked about tokenization through a government sponsored vehicle, right? And we talked about anti-money laundering, and we talked about regulation for even operating in the space. And
Hmm.
it seems like the crypto space and even the DeFi space is gradually moving closer and closer to the TradFi space, right? So
Yeah,
the
I would
lines
say
are
so.
kind of blurring, right? and
Yeah,
and these
massively.
industries, yeah, and the interoperability between fiat and crypto, and real world assets and tokenized assets is kind of starting to become very, very vague. So how do you view this whole financial landscape, crypto and TradFi, in, let's say, 3 years from now? Because things are moving very, very fast. Where
Yeah,
will we
that's
be in 3 years?
I mean, overall, I'm a big believer in that every asset will move on chain, that we will have seen every asset in some shape or form on a digital ledger, right? Doesn't mean that all assets necessarily will be on blockchains, but I think the majority of these assets will be in blockchain, because what we're seeing now is that massive institutions are moving in and they're realizing, a lot of value that blockchains can bring to the table. So I think that trend definitely will continue, and I think that's maybe also, or hopefully, a bit comforting for some people who feel a bit down with the current prices. But for example, the TVL I saw today, the TVL for the eighth protocol is at all-time high. Still, even after all these prices are down and so on. So I think DeFi, like really good made DeFi protocols, will merge closer together with the financial institutions that we have. So in the future, you won't really be able to distinguish, are you holding a wallet, or do you used to have a bank account? And then within your wallet, you will have access to all these DeFi opportunities. Some of them will be traditional, probably, let's say some traditional bonds, but probably the bonds will then already also exist on a blockchain, right, and being traded on a blockchain. So I think that's where we're gonna head, and I think it's pretty exciting.
Yeah, sounds exciting indeed. And my humble opinion about the prices, I think that versus the previous waves of ups and downs and and bears and bulls and so on, I
Hmm.
think that this time around, with all the interconnection that we just mentioned between
Hmm.
TradFi and DeFi, and with all the institutional funds that have flown into crypto, I
Yeah,
think that we're past the moment where a fluctuation in the price is something that can be perilous for the industry. I think that
I think so. Yeah.
we're already there with respect to adoption.
No, I would agree. It used to be that the price was kind of the narrative, as people would say, right? So the price was everything, but the price is still a lot of the attention, but it's not everything anymore, because a lot of these KPIs, even if prices have fallen, I think they're never going to go back to these levels that we've seen maybe even one year ago or 2 years ago. I think because all of these institutions moving in, more capital moving in, and some of that might temporarily leave again. But the overall kind of floor is is of a much higher nature.
For sure, for sure. Sebastian, on this note, I really want to thank you. I think that what you guys are doing at Mantra is really special and interesting and unique. You're pioneering the industry with respect to tokenization and with respect to bringing closer DeFi and TradFi. So kudos on that, and thank you so much for this interview.
Yeah, thank you so much, Michael. Was a great time talking to you, and I hope I could clarify some of the compliance questions to some people out there.
Sure thing. Thank you.
Web3 Watchdogs is sponsored by Cybers, your one-stop shop for Web3 security and threat mitigation. Cybers harnesses the power of AI to eliminate hacks, scams, fraud, and compliance challenges in real time, and even before they happen. For more information, visit cybers.ai. That's CYVERS.ai.